makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Our earnings season in full swing, from Wall Street banks to the world's biggest manufacturer of semiconductors. We discuss the equities and macro outlook in just a moment with our guests. But first, the White House has floated the potential for a longer-term truce in the trade war with China. Now, the U.S. Treasury Secretary Scott Bessent says a possibility of extending a pause of import duties on Chinese goods for longer than 3 months does exists, but only if China halts its plan for strict new export controls on rare earth elements.
Right now, we are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps, but all that's going to be negotiated in the coming weeks.
Let's get more with Ross Matheson, our chief Asia correspondent. So, Ross, where do we actually go from here? It's unclear if this escalates a little bit or it just stays as it is, but for a very long time.
Well, what we've had, of course, is a rolling series of extensions of a trade truce, and what Scott Bessent is floating is you could make that longer, but China would have to retract some of its rare earth moves. The most recent one was that if you export pretty much anything, even with the trace element of rare earths, you've got to get permission. And maybe China walks that back and they get a longer truce out of it. But really, rare earths are the ultimate leverage for China. This is their big bargaining chip. Would you be willing to do that just to get a longer extension of a trade truce, or do you want something more fundamental? And do you want something more fundamental, particularly out of a meeting between Xi Jinping and Donald Trump? Are you going to give everything away on rare earths just to get this truce rolled over for a bit longer? I mean, maybe they can walk some of it back, but it's also worth noting that China has made lots of promises on rare earths and said they're going to open the spigot and then not really followed through. And so maybe they can promise stuff and see if they can just push that further down the line. But, Scott Bessent was saying the main thing here is like when the two leaders, or if the two leaders sit down, that's when you're probably going to get that proper negotiation happen.
Is it likely, actually, that the two leaders sit down?
Well, Bessent seems to say so, and so do other US officials. And they're saying despite all of these tit-for-tat actions and all the rhetoric between the two countries, which is ratcheting up, that there is a line of communication open. There are still meetings going on between US and China officials. Scott Bessent says that he's going to meet the Vice President, He Lifeng, before the end of the month, perhaps before this meeting. As far as he knows, the meeting is on. Does it come down to the last minute whether Xi Jinping and Donald Trump decide it's in their interest to have the meeting? Will they get something out of it? That will be the ultimate question. But it seems as though, despite all of this noise and actions, they are still talking to each other.
Okay, which is always a good thing. I mean, there's just a lot going on. There's also earnings. We're in full swing. We've had a lot of U.S. banks reporting. The other main focus, AI-related stocks yesterday. ASML added to optimism that artificial intelligence boom can still power corporate earnings. And today, Taiwan Semiconductor Manufacturing also hiked its projection for 2025 revenue growth to the mid-30 range. Again, a strong signal of confidence in demand for components like the NVIDIA chips that power AI. On the flip side, a company like Pernod Ricard faced extra tariffs around the world. It reported worse than expected sales on a sharp slump in demand in China, but also clearing out of excess in the U.S. And then the other big story, Nestlé, cutting 16,000 jobs as a new chief executive officer seeks to accelerate the turnaround. So to talk markets, let's also bring in Simon Kennedy, our senior executive editor for macro markets. Simon, we're just talking about U.S.-China. I mean, I guess the market is focusing so much on earnings, maybe they're not fully pricing in what's happening in this trade war.
Yeah, I think there's three things going on. You've got these earnings, and you've got the bank earnings earlier in the week, which were pretty robust. So you've got the bank earnings, the technology earnings, all pointing in a good direction for equities. Secondly, you've got this AI boom. Is it a bubble? That's perhaps a longer answer on a different day, but you've got this AI boom. So you've got those two things that are exciting the markets. And then you've got the China issue, the tit for tat, the kind of the headlines. It's one step forward, two steps back. And so the market's kind of assuming that at some point the China-US trade deal will be made and that they'll all move on, and the whole idea that the president speaks robustly and then pulls back a little. You've seen that a few times in recent days. So they're able to kind of put the Chinese situation aside a little because they're so excited about the earnings, they're so excited about AI.
So is it also fair to say that they're kind of that markets are brushing off any concerns about tariffs, or they've moved on from the tariff concerns to fully focus on the Fed?
I don't think they've moved on from the tariff concerns. They know they're there. They're certainly seeing them on their screens with all the different headlines, first from the White House and then from Beijing. So they're alert to it, but they're also thinking they don't quite know the full story yet, and they think, given past performance, that there'll be some kind of concessions at some point, and we'll get this Trump-Xi meeting, and other pullbacks will occur, as indeed the Treasury Secretary was talking about last night, in speculating about the opportunities for long-term truce. And yes, obviously you've got the Fed. We're reporting today there's some people in options markets starting to price in a supersized Fed cut in at some point this year, which would probably require some economic data, which clearly we don't have, but also you'd then be pivoting into recession concerns. But yeah, the feeling now is that Jay Powell certainly didn't change those feelings the other day, that more cuts are coming in the next few weeks, and that'll be another fill-up to this bull run.
I mean, data we don't have because of the government shutdown, which is talked about a lot less. But Ross, there's been quite a lot, going on with President Trump. I don't know whether the perception of the U.S. has changed globally also because of what he's achieved for Gaza.
Well, it's interesting because, of course, he's touting himself as the president for peace, and he really did, arguably push a ceasefire in Gaza. There'd been months and months and months of negotiations that were struggling to get a deal, and it arguably was Donald Trump that helped facilitate it and get it over the line. Does it hold is another question entirely. What are the longer-term challenges for Gaza? Another question entirely. We're going to get into some very tricky territory about governance and so on, and the future rule of Gaza. And tensions in the Middle East haven't just magically dissipated completely because we have this deal. There's still big questions around Iran, but Donald Trump can say, well, I helped facilitate that, and arguably other ceasefires around the world, Thailand, Cambodia, in Asia, we've got Pakistan and Afghanistan now taking pot shots at each other. So you've got that aspect of it, but you've also got a US that has pulled back from a kind of a values-led, behaviour globally, cuts to USAID, cuts to organisations around the world, including those that are pushing for peace and for freedom of the press. And so you've got these dueling aspects of a very transactional presidency. Again, what is Donald Trump doing is not just necessarily what he sees as good for the world, but good for the US.
Also joining us, thank you, Ross. Also joining us is Jimmy Muchechetere, a senior equity analyst at Investec. Jimmy, welcome to the program. We were just talking a little bit about, the U.S. stock market and stock markets in general, U.S. China, and actually, I guess, this renewed clout for the Trump administration. We have a lot of earnings. Where are the market? Is it frothy? I mean, they have good earnings, but are there a lot of stocks priced to perfection?
There are certainly pockets where things are quite frothy. One interesting stat I came across this morning was that the median S&P 500 stock is 13% below its 52-week highs, and 1/3 of S&P 500 stocks are 20% lower than their 52-week high. So
expensive.
So there's a bifurcation. They've got the really, really expensive stocks, anything AI, nuclear, power related, and then everything else.
So where do you see, I don't know whether you're looking at earnings season or you're, looking at what we were talking about, U.S. China, to see where you put your money and the best investment opportunities? Yeah,
100%. For us, it is earnings season. We are in hyperdrive right now. As we have seen, the companies that have reported so far, the financials, they've done really well. They've traveled really well into the earnings season, and they have delivered. And that's, I think, where we think things will continue. So if the AI stocks continue to deliver, whether it's earnings growth, free cash flow growth, some semblance of returns on AI investments, then we think those will continue to work.
But Jimmy, I'll ask Simon in a second to have like a roundup of the U.S. economy. But if you look at AI, the big question is, are we in a bubble? Because when you invest a lot in AI, if you don't get that return, then maybe these valuations don't make that much sense.
100%. We think there are pockets of frothiness, particularly in some of the neo-clouds, some of the private debt deals that we're seeing, some of the power stocks that I've mentioned, the nuclear stocks. But in terms of the hyperscalers themselves, we don't think we're in a bubble. We think we're in the early stages. So if you look at the average cost of a gigawatt is something like $50 billion, and we expect a cadence of 20 gigawatts per year for the next few years, really. That's $1 trillion capex that's being used. That can easily be covered by the operating cash flow of the big hyperscalers the co-locators, as well as the sovereign AI. But that's not to say that there aren't pockets where we think there's a bit of frothiness.
I mean, I want to ask you about U.S. corporates specifically, but how difficult, Simon, is it to read the U.S. economy right now, given we are lacking data?
Well, yeah, we're flying blind. We've got the private sector data, obviously, but we've not got the government data. And when we do get the government data, it's all going to land quite quickly. And so the markets are going to spend... There's been a low volatility period, certainly in bonds, and suddenly you get all this data and you're trying to work out very quickly what it means. And as Jerome Powell has talked about, it's a kind of no hire, no fire kind of labour market. And if one of those changes, we suddenly get firings, then it's going to be off to the races for the Fed and the recession concerns, which have been dormant for most of this year. You wouldn't have maybe predicted that this time last year. The recession fear of last year has kind of gone aside, which is great, but also kind of sets up for the fall at some point.
Jimmy, what's your take on U.S. stocks specifically?
No, we agree 100%. I think as long as they continue to deliver, which is what we are saying, we think they'll continue to perform. And, right now, we've got an environment where there's more liquidity, there's less regulation. Yes, there's political noise, particularly with the government shutdown. But, once that's out of the way, we are going to get legislation going through. We're going to get Clarity Act, for example, following on from... the other stablecoin X that we're seeing, we're getting more deals and IPOs in the market. I cover healthcare. We're starting to see that going on. The financials have reported Goldman Sachs had, the highest ever investment deal revenue they've ever had in their history. So did JP Morgan. We're starting to see, a lot of financial activity happening. So, the brakes are still on. But to his point, as soon as those are released, we think the U.S. market will continue to.
But I think, and correct me if I'm wrong, but a lot of the M&A or IPO activities in specific sectors.
Yes.
It feels like there are specific sectors that are just powering ahead and the rest is kind of lingering.
Yes, 100%. So you look at biotech, for example. In 2023, we had 140 deals, including IPOs. So far, we've had 10. So, there's a lot of pent-up demand. There's a lot of money waiting in the wings. The big pharma companies need to infill their pipelines. And there's a lot of very solid technology that's sitting in the wings, and so what we just need is for the regulators to stand out of the way, and then this money will come into the market.
Do you see value in Europe? I know there's many question
100%.
marks on the competitiveness of European companies.
Yeah, 100%. I mean, we were looking at companies like LSEG, companies like RELX, SAP. They really lagged their US peers, and we continue to see them as winners pre and post AI, and we think there is a lot of value sitting there. Yeah, I mean the defense companies are slightly different.
The defense company. Why do you think they're different? I mean,
the valuations have run up, and there are questions emerging as to the sustainability of Euro defense spending.
Yeah.
You were seeing a lot of turmoil in France, for example. There are challenges here which are going to be aired out when the UK budget comes in a few weeks' time. So, is that defense spending really sustainable? There are question marks, and a lot of the European stocks have already moved to price that in.
And I guess because of national pride, it's very difficult to see that sector also consolidate, which it probably needs it in Europe.
Yes, 100%. Yeah, I mean, in the past, valuations used to be much cheaper than the US defense primes, but now that gap is closed. In fact, Europeans are actually trading at a slight premium to the US defense primes. So, deals will be hard to get in the Europe.
Question marks. Thank you all for joining us. Jimmy Muchechetere there, Senior Equity Analyst at Investec, and Bloomberg's Simon Kennedy and Roz Matheson. Now, coming up, the world's biggest chip maker, TSMC, reports better than expected earnings, underscoring robust spending on AI infrastructure. We'll discuss that next, and this is Bloomberg. Welcome back, everyone. Now, TSMC has raised its revenue growth outlook after posting better than expected quarterly earnings. Now, the results underscore how TSMC, the go-to chip maker for Apple and most of the world's largest chip designers, remains one of the biggest beneficiaries of a spending spree on AI infrastructure. Now, OpenAI, the world's most valuable startup, has already struck deals for data centers and chips that top $1 trillion. Well, we're joined by Matt Bloxham, Senior Technology Analyst from Bloomberg Intelligence, and Parmy Olson, who covers tech for Bloomberg Opinion. So thank you both for joining us. Matt, let's start with you just on the earnings. I mean, TSMC today, like ASML yesterday, it feels like we talk about valuations, but they can't do any wrong for now.
Yeah, that's right. We're still very much in that kind of growth surge, and there's a huge amount of investment going into AI, and these guys are the primary beneficiaries of that. You know, TSMC is by far and away the most advanced manufacturer of chips, and so in huge demand from the likes of NVIDIA and Apple. And I think today probably actually because they reported the revenue number for Q3 last week, so maybe not so much of a surprise that we saw that revenue guidance upgrade. Yeah. And I think analysts have got a little bit of a way to go to get there, but not much. I think the more encouraging thing today was the better than expected gross margin. So they're essentially getting more efficient at the chips that they're producing.
Parmy, what can you tell us? I mean, I know you spend quite a lot of time, to try and think exactly what AI will become and how they make money out of it. So we heard from Ken Griffin. I mean, there's been so much spending in AI. When are we actually going to see some returns? Is that one of the big overarching questions that we should really be asking ourselves?
Well, it was interesting. Ken Griffin's points are really about how banks are using AI, and I think that's where it's still a little bit of a gray area. And there's a lot of caution in that industry, of course, because these models still hallucinate, they make mistakes. But there's other industries where we're seeing huge changes in the legal field, in marketing, customer service. It's massively being used, and we're seeing a huge decline in job openings for graduates. There was just a stat I saw yesterday from Reed, which is the recruitment company here in the UK, and they were saying that graduate jobs had fallen by 2/3 in just openings in the last 3 years, from like 180,000 to 50,000 last year. You can attribute that to lots of things: the economy, hiring freezes, the hike in national insurance here in the UK. But there is a real tendency when companies use AI to use it for the tasks that the entry-level workers use. And I think that's a little bit of a sign. And the other thing, of course, is that consumers are absolutely embracing this technology. ChatGPT has 800 million weekly users. That's like a 10% of the global population. It's probably going to hit 1 billion by the end of this year. Where things are slow and kind of fraught is in business, which, of course, where all the money is going to be for OpenAI. But I think that's just going to take years to come through, if it does eventually. Even that is not kind of guaranteed.
So, and this is actually that goes back to valuations, but we're also hearing, for example, from TSMC and others that the spending is definitely there and increasing.
It is there, but as I say, it's kind of being spent by the likes of OpenAI, and in this slightly circular way to kind of build the capacity for demand that maybe is evolving but isn't fully there yet. And I guess the big missing piece for a lot of people is what's the actual revenue model attached to this. OpenAI doesn't really have a revenue model. Google doesn't really have much of a revenue model either. And I think obviously maybe it's all going to come back to advertising again. But if ChatGPT needs to make a return on this huge investment, up to $1 trillion of investment from advertising, that's going to be a massive disruption to the existing digital advertising ecosystem.
Parmy, you have a really interesting piece that I have to say caught me by surprise, because it's not something that people write or have figured out. But you basically say that, ChatGPT has engaged in erotica, right, with verified adult users. And that's actually, is it a way to make money, or is this a business model?
Oh, 100% it's a way to make money. Just as you were saying, they're probably going to have to resort to advertising to monetize these 800 million users they've got, because most of those people don't pay for ChatGPT. So it's not just the erotic content that's coming in December. It's also this new app called Sora, which is like TikTok. That's a perfect place to put ads. And OpenAI has hired executives who have real experience in creating ad businesses. So all the signs point to that being directionally where they're going to go. And the erotic content thing, which I think feels a little bit distasteful, but it's a very lucrative business. Chatbot companies that take that away, that put restrictions in, lose millions of users. We saw that with Replica, with Character AI. And I think what OpenAI is hoping is that if they add that, they're going to get more subscriptions and they'll just get many, many more users.
And again, the numbers, I mean, you were, in your piece that I think everyone should read, it says roughly 30% of prompts typed into some of these AI assistants are of a romantic or sexual nature.
It's that stat blew me away when I heard that, and that I heard that from a company who has been in this field. It's the longest sort of reigning chatbot company called Pandora Bots, based in San Francisco, and that's just what they've seen across the board from speaking to companies and investors and founders, that 30% of the inputs into these general purpose chatbots are sexual or romantic in nature. It's just some sort of base human instinct, I suppose you could say. But what I kind of find fascinating about all this is that we talk about the transformative effect of AI on business, how it's going to uplift civilization. But right now what we're seeing is this effort to kind of capitalize on these basest, these human instincts and make money from it.
So I mean, there's definitely a mismatch, right? And again, it goes back to kind of when do you capitalize on some of the investments? I mean, is there, when you look at different business models, what are companies saying?
I mean, obviously, companies, it's a kind of more straightforward kind of monetization. If you're a big corporate and you're kind of calling APIs into large language models, you're being charged for it, and you can afford to pay for it, and you're at least looking to try and create a return on investment, whether it's kind of by fewer graduate jobs or other efficiencies. But that's a much more complex value chain. You're not going straight to OpenAI. You've kind of got Microsoft or another service provider in there. There's Oracle sitting there somewhere in this. So it's a very complex value chain, and everybody's taking a bit of that money. And I guess one of the pressures maybe for someone like OpenAI is that although a lot of their investment has come from venture capital firms and people that have got kind of patient capital, they are now actually having to turn to less patient capital, kind of more traditional debt, and they want their money back. You have to pay interest on it, and so that's maybe where some of the pressure's coming to actually kind of accelerate some of these kind of revenue generating opportunities. I'm sure Sam Altman doesn't want ChatGPT to kind of be synonymous with erotica, but kind of filling this gap before it becomes this kind of grander thing that they hope it to be mid to long term.
And Parmy, I mean, you were part of like a team of three that put together these three big questions that we should be asking ourselves. And it's, can Europe fix its investing problem? Will AI's U.S. copyright war be its undoing? And will China's AI dragons eat each other alive? Like, after, if you look at these three questions, what's the hardest one to answer?
Well, the one that I thought was hard to answer and that I cared about was, why isn't Europe making money from its incredible tech and scientific innovation? I mean, this is a region where we had the World Wide Web was invented here. Alan Turing, the father of artificial intelligence and computer science, was here. DNA sequencing happened. The struggle in this country and Europe widely is commercializing that at scale. And sometimes that's cultural. Tim Berners-Lee chose to give away access to the World Wide Web and not monetize it. That was his decision. But I think a big part is we're just not getting the spending, the large-scale spending that we need for startups here in Europe. And what you hear in the public discourse is it's regulation. Let's blame the tight regulation from the European Commission, from the CMA here in the UK. That's what's holding everybody back. I think that's a huge red herring. I don't think that's actually what's holding back the environment here. I'll give you an example. Last year, a fantastic UK startup called Wave tried to raise $1 billion, couldn't raise any of it locally, had to go to the US for it.
There you have it. Thank you both. Matt Bloxham there from Bloomberg Intelligence, Bloomberg opinion columnist Parmy Olson, also author of one of my favorite books, Supremacy, AI, ChatGPT, and the Race That Will Change the World. This is Bloomberg. Good morning, everyone, and welcome back to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump acknowledges America is in a long-term trade war with China. Treasury Secretary Scott Bessent warns Beijing of a coordinated response to rare earth restrictions. Now, the world's largest chip maker, TSMC, delivers stronger than expected earnings, a sign that global demand for AI infrastructure remains red hot. And Nestlé plans to cut 16,000 jobs worldwide as a new chief executive of the Swiss food giant moves swiftly to accelerate a turnaround. Now, Wall Street's biggest banks are taking advantage of rising stock underwriting after a powerful equity rally reignited the IPO market, fueling double-digit percentage gains in advisory revenue. So joining us now is Jenny Serene, our finance editor. Jenny has been all over the U.S., of course, earnings. It's been a big couple of days. Stock trading, Jenny, was the real standout performer this quarter. What's driving these huge gains?
Yeah, I think it's a couple of different things. So obviously you still have a lot of volatility around the trade war that you were just talking about. You've got clients looking to really get in on this action, and so the banks are taking advantage of that. A lot of them are also pointing to their prime brokerage units. So you see hedge funds and other big asset managers really looking to kind of take advantage, get bigger in this environment. And so this was kind of a boon all around for these revenues. We did hear, though, from the folks over at Morgan Stanley, that was something that could be a risk. If you start to see equity prices come down, then that sort of impacts the prime brokerage unit. So it wasn't all good news on the stock trading front in terms of the outlook. But for the most part, these banks are really excited about this business and, gearing up for what's more ahead.
What can you tell us about AI, what Chief Executive said, how they're using AI in their business? And I think one of our most read stories is Ken Griffin on Gen AI.
Yeah, no, it was interesting because that was definitely the talk of the town on all these earnings calls this week. So even though we haven't quite seen AI impact these banks on a headcount front quite yet, it seemed like they were all preparing for that in the future. So you heard them talking a lot about how this technology is transforming the way they work. They're getting a lot of the efficiencies out of it. It's going to help them on the cost front later down the line. And so while headcount was largely stable across the industry, we do think that that's something that we'll probably see more of to come.
Yeah, and then Jamie Dimon, of course, never disappoints. If you look at the blow-ups in the credit market, they've definitely then sparked this war of words between, banks and private credit on who's better positioned to basically deal with this downturn, possible downturn.
Yeah, it was interesting because it was such an unusual quarter where provisions and just credit costs overall still look really pristine. So we obviously had this 2 high-profile bankruptcies over in the U.S. of First Brands and Tricolor, but still, for the most part, these banks are managing okay. And so that's why I think you see these comments like the ones that Jamie Dimon made about, we're worried that there's other cockroaches to come. I think they really take off because it's just such a hard environment to make sense of, where you have these headline-grabbing instances, and yet at the same time, the earnings are still so stable. And so I think everybody's just kind of waiting for that next shoe to drop.
Yeah, it's so difficult. I mean, as soon as you have a blow up, you kind of think, is it a real blow? Is it a canary in the coal mine? Is it something that can actually, all sorts of animal analogies, or is it just something like, 1 or 2 and done?
Yeah, no, I think that's exactly right. And it's the provision numbers that we're seeing are still showing that things are broadly stable. Corporates are keeping up. Consumers are charging ahead. But definitely everyone's just worried and waiting. So.
Jenny, thank you so much. Jenny and her team really, really working hard this week. Our finance editor, Jennifer Serene. Now, from Wall Street earnings to the changing nature of investment management and how some of the top players are advising clients during these times of macro volatility. Well, joining us now is Bryon Lake, Global Head of Third-Party Wealth at Goldman Sachs Asset Management. Bryon, you win the title of the week. Oh. And this is something that we wanted to chat about. First of all, thank you for coming on. But third-party wealth is basically the idea that you package up some of the products that clients want.
Yeah. So we sit within the Goldman Sachs Asset Management. So it's the asset management arm of the broader bank, Goldman Sachs. And we have our own investment capabilities, and we deliver those to investors around the world. In the third-party wealth business, me and my co-head focus on clients that are like private banks or deal with individuals that have wealth there. And so those are the clients that we're serving.
And our clients are asking for different products. So it used to be stocks and bonds, maybe 60-40, then you had a couple of the quirky stuff. Maybe you mentioned the CDSs, but actually the nature of finance is really changing.
Yeah, absolutely. I think not only is the nature changing, but we're at this inflection point where how investors are getting exposure to the market is changing as well. So yes, of course, stocks and bonds on the public side. And increasingly, investors are looking to get that exposure through the ETF wrapper. It's been really well talked about, and I think investors are understanding how they can deliver great outcomes for their clients using the benefit-rich ETF wrapper. So we know it trades throughout the day, it's transparent, it tends to be lower cost. But what we're really seeing as the interesting part right now is you can take active management and deliver that into the ETF wrapper. So you're getting the benefits of the ETF wrapper plus active management.
So how does that change the nature actually of risk appetite across your clients' profiles?
Yeah, so I mean, a lot of clients right now are watching these markets. It's obviously an AI kind of led market, but what they're also seeing is that some of these individual tech names are becoming bigger parts of the benchmark. And so when you're thinking about using active management, where you have either a quantitative approach or a fundamental approach, to think about how you're weighting those companies within the portfolio, that can really be a differentiator. And so if you think that these tech names have become a too big a part of the benchmark, maybe active management can help you manage that risk in a slightly different way, where you can still get exposure to names that have great potential going forward, but you're not overexposed to one or two different names.
I mean, Ken Griffin just said it very plainly, like, Gen AI at the moment is not delivering alpha.
Yeah.
Does that change some of the, the products that clients will want once we get to that point, or are we assuming that in certain parts of the market is already happening?
Well, I think anybody that's interacted with AI can see the potential.
Yeah.
And so I think we're at this moment where the potential is there, but how it pulls through the system and impacts things in a very material way is still being worked out. Where we've had success implementing AI within Goldman is on very specific use cases where you can do targeted things with somebody that owns that within the system, and it actually is having significant unlock to our platform. So we're really excited about that, and we are seeing AI actually have an impact on what we're doing.
Talk to me about private markets.
Yeah, perfect.
I mean, that's changing. It's changing everything.
Exactly. Yeah. So if you step back for a second and think about Goldman Sachs Asset Management, we're actually the 8th largest asset manager in the world. We announced earnings earlier this week. We have $3.4 trillion in assets under management. We're a top 5 public active manager, so public stocks and bonds, to your point earlier. Yeah. We're also a top 5 private manager, so private equity, private credit, infrastructure, real estate. These are all different alternative or private investments that can play a big part in investors' portfolios. So, maybe you use private equity to enhance returns. Yep. Maybe use private credit to enhance yield. Maybe real estate or infrastructure as a diversification or a yield play. And so, similar to the ETF story being a how do I get exposure to these and what's the way that I access that, you're seeing that happen in the alternative space as well with more evergreen products.
I mean, do you have any concerns in certain types of actually private credit tools that are being used? I mean, there's, we go back to the risk appetite, it's some of these valuations. Again, if there's something that's blowing up, what's the repercussion of that? Yeah, well,
of course, we encourage everybody to make sure that they're doing their due diligence and understanding what it is that they're investing in. I know that we've been talking about, the industry's been talking about private credit a lot more over the last couple of years. Yeah. Goldman's been in the business for 30 years. And so we have a long track record of thinking about this. And so we're really focused on making sure we have good underwriting and making sure we're focused in the right sectors. And so how we construct this portfolio, we're incredibly intentional about doing that. And so, of course, do your due diligence. But on our side, that's something that we're extremely focused on when we're thinking about the management of these portfolios. So
what sectors do you focus on, given also everything that's being thrown at a lot of corporates? This could be U.S. trade. Yeah. It could be, China's structural fundamentals changing.
Well, I think the way that I would answer that question is that we try to stay away from the overly cyclical sectors, right? Like we want durable sectors that we think can navigate through this. And then I think on that point, it's more on the credit by credit issue, the different companies that we like within the portfolio. And so the team does an excellent job of thinking through what they're doing there.
Bryon, at what point will some of the offerings on private credit or private markets become bigger than the public ones?
I don't know that it'll become bigger. I think what we're seeing is this convergence. And so when I think about being an investor and sitting in my portfolio, I think about all the options that I have on the public side and all the options that I have on the private side. And depending on the market environment that we're in, I may want to use one of on the private side. I might increase that allocation, or I might want to be on the public side. And I think that what we'll see is that that'll ebb and flow as the markets give us different environments.
I mean, Europeans traditionally, because of regulation, have just been more, I don't know whether you'd describe it as more hesitant or not as enthusiastic as, for example, American investors, be it institutional or retail. Is that still the case?
I don't know. I think what investors are looking at is they're always thinking about the risk-reward profile, right? And so when I'm having conversations, particularly on the active ETF side, for example, Europe's having a record year in the adoption of active ETFs within their portfolio. So I think that adoption is actually happening at a faster rate here in Europe than it is in the U.S. It's bigger in the U.S. It's been going for a little bit longer time.
Because of the tax breaks?
Well, the tax efficiency is one of the benefits, but the intraday trading, and not everybody's a day trader, but everybody's a risk manager. And so in this day and age where real time, the numbers are scrolling at the bottom of the screen and news is breaking, it's important for investors to know what's going on in their portfolio. And so the nature of an ETF giving you real-time pricing throughout the day, allowing you to manage that risk on a real-time basis is one of the big benefits of ETFs. So in the U.S., there is some tax advantages to that. But when I talk to investors here in Europe, and we've been traveling across the region, I was in Italy earlier, Berlin yesterday, and we're on to France tomorrow, they really like that intraday trading where they can watch what's happening and manage that risk real time. They also like the transparency. I know exactly what I own. I can go on Goldman Sachs' website, see every single one of the holdings on both the equity and the fixed income side. That gives them a great deal of understanding of what's happening in their portfolio.
Sophisticated investors. Bryon, thank you so much for joining us. Bryon Lake there, a global co-head of third-party wealth at Goldman Sachs Asset Management. Now on to other corporate news, and Swiss food maker Nestlé has announced plans to axe 16,000 jobs, 6% of the workforce over the next 2 years, as the new CEO seeks to fast-track a turnaround. We're also joined by Jennifer Creary, our global business reporter. Jennifer, thank you for joining us. I mean, 16,000 is a big amount, but also means that the CEO is moving fast.
Yeah, exactly. So this is all part of the ambitious cost-saving program, which actually today Nestlé raised its cost savings up from 2.5 billion Swiss francs to 3 billion Swiss francs. And 16,000 jobs, that's 6% of the overall workforce. Nestlé said that it's going to spread this out over 2 years, concentrated in white-collar jobs. So certainly the new CEO is moving fast, bearing in mind he only took the helm last month. So a lot of these moves arguably were made under his predecessor. But certainly he's looking to carry that forward. If you look at the share price reaction this morning, investors are pretty happy.
Yeah, I mean, the results weren't great, right? It's been like that for a couple of quarters, which is also, one of the concerns that a lot of these big consumer groups have.
Yeah, exactly. So, I mean, Nestlé is in turnaround mode. I think one quote from the new CEO that really encapsulates this is, the world is changing and Nestlé needs to change faster. So its third quarter results actually beat analyst estimates. There was no change to outlook. Certainly, Nestlé has a lot of challenges on the horizon. So they've got the potential sale of their vitamin business, finding a potential partner for its bottled water business. So there's a lot of challenges that the new CEO has to tackle, and it's really just the start.
Jennifer, thank you so much. Jennifer Creary, there, our global business reporter. Coming up, the latest insight into diversity in the boardroom. We discuss all of this with Miranda Brawn, author of the new report from the Brawn Review. This is Bloomberg. Now, the conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, as earnings season gets underway, corporate board members will be reviewing their company's performances and deciding what they do next. My next guest argues that in order for boardrooms to make the best decisions possible, corporate board members need to represent a wide range of views and backgrounds. Now, the Brawn Review report published today provides 50 recommendations to help organizations to become more inclusive and sustainable. Joining us now is Miranda Brawn, the author of the report and founder of the Brawn Review and Miranda Brawn Diversity Leadership Foundation. Miranda, first of all, congratulations. The report is out. I know you and the team have been working really hard on it. Yeah. So what exactly have you seen?
Yeah, so in terms of the findings, there has been... So I came on at the start of the year when we were talking about this back in January 2025. And so we were talking about the potential backlash. There has been a backlash. There has been a decline when it comes to sustainability, diversity, inclusion within the boardroom and across organisations. But there has also been a rebranding, and that's one of the findings that we found. And the report also covers not just the corporate boardroom, but all different boardrooms. So we're covering lots of different sectors, from the listed to the private to the public to the third sectors. And so it's really a case of lots of organisations are rebranding. So rather than they call it diversity, equity and inclusion, they are calling it people, culture, talent. So the work is still happening behind the scenes, and I hope I'm not revealing any secrets here, but there is work still happening, but it is definitely happening at a slower pace. Okay. And even with the...
And does this depend on industries, Miranda, or is it just across the board?
It's across the board, but I think particularly within the corporate industry, that has definitely slowed. But with all of the global organisations that have contributed, and we've had over 1,000 board members around the world who have contributed on lots of different organisations. And so the feedback is that they do want to support sustainability and inclusion and diversity. They know there's more that we need to do. When we look at the statistics, 78% of the contributors within the boardroom have said that they know more needs to be done. 86% are not sure on the next step. So the Brawn review provides you with 50 recommendations. But what makes us different than any other review out there is that we're not just focusing on gender or race or social mobility, but we cover all of the diversity strands. So we've got age in there.
Bryon, can I just go back to a point where you say people feel like they need to do better? I mean, there's a lot. We cover it on the show every day. It's US-China. It's, a lot of UK politics, actually, some of the NICs going up. Is it because people are overwhelmed, or what is the reason why they feel like they need to do better because they're not doing it now? Like, if you feel like you need to do better, you should just do it.
Yeah. I think it's a combination. So we've got various regulations, legislations coming from the US, and I think that's having a ripple effect within the UK organisations, especially the global organisations that might have their headquarters in the US. So you've got that aspect. But even before that, we still were not on point. So there's a lot more that we need to do. We are behind. And my charity, the Miranda Brawn Diversity Leadership Foundation, we're 10 years old today. And yes, there has been progress. And I think we really need to be encouraged to know that there has been progress over the years, but there's a lot more that needs to be done. And so with the recommendations within the Brawn review, this really does highlight across all the different diversity strands, all the different sectors, in terms of what organisations can be doing to take the next steps to actually make that change so that we can have progress at a faster pace.
Miranda, I want to talk about the recommendations in just a second, but let's also quickly just go to France because there's a lot going on. Alan Katz, our bureau chief, is looking at Parliament right now to try and figure out whether the French Prime Minister once again stays on, whether he can or cannot. Lawmakers voting on 2 no-confidence motions against Sébastien Lecornu after flagging plans to suspend controversial pension reform. So Alan Katz, our Paris bureau chief, is watching the conversation right now. What do we know, Alan, and actually what do you think happens next?
So the discussion is actually sort of wrapping up at the moment, and parliamentarians are about to go out to vote. So it's been 2 hours of discussions, some angry words from both the far left of the France Unbowed Party and from Marine Le Pen early on. And from Éric Ciotti, also an ally of Marine Le Pen, I guess some more stabilizing words from the government supporters, and the socialists who said they will not vote for the censure today or vote to oust the government today, but that in no way prevents them from doing so down the road should they come to real disagreements with the government. So the way it looks at the moment is still the way that we have it in our story, which is that it looks like the Prime Minister, Sébastien Lecornu, is set to survive this vote. There are a few socialists who are probably going to disobey party recommendations and vote in this no confidence motion anyway, but it shouldn't be enough to actually push him out. That's at least the way it looks at the moment.
Alan, I mean, how big is this tax debate in France? I know we also heard from people close to Bernard Arnault about the wealth tax.
It's really big. I mean, that's fundamentally, it's really what's going on here right now is the question of how does France pay for basically many of its social services, including retirement, and who pays for it? And so the question is, how much of it comes from regular French people, how much of it comes from the very wealthy like Bernard Arnault? It really is sort of it's a crux issue in France right now and becoming ever more so, and it's going to be the issue around which the debate over the budget, should Lecornu survive, that debate turns.
Alan, thank you so much. Alan Katz, our Paris bureau chief, of course, with that debate in Parliament. Now let's go back to Miranda Brawn from the Brawn Review. I love it, Miranda. We talked about why there's a problem, and now you can give me the solutions.
Yes.
So what I love about your report is that you basically say, look, these are the 50 things that you should be thinking about that would make a real difference.
Yes. Definitely. So some of those recommendations include actually having an age-diverse board. It provides better strategic decisions in terms of the decision making. They also, and this is a controversial point within the recommendations, but then the majority of the contributors have said have board champions, but in particular a menopause board champion. So that's a really interesting going through that journey with the findings. But it's having a board champion across all the different diversity strands. So not just menopause, women's health, but also disability, LGBTQ+, and so on. But there's also, when we're looking at sustainability, one of the other recommendations is to actually redefine it. So I think when people think about sustainability and ESG, the environment, the social and the governance, they think about the environment. And it's really important to define that. So you've got the social and the financial aspect as well. But then there was also, one of the findings was that if you have a more inclusive board, 10 times more innovative and productive in terms of the boardroom and the organisation. So it's really important to focus on these aspects. But Lord Davis, he was the founder of the Davis Review that started all of these reviews back in 2010. And this was a UK government-backed research to help increase gender diversity by 25% within the FTSE 100 companies. He's backing this report and all of the next steps. And his feedback within this is we've really got to look at the headhunters, because what he found was that the board recruiters, they were showing the same names and the same faces. And so what he did, he went beyond that and he located himself his own diverse board member. We've got Baroness Doreen Lawrence, who has also recommended that there needs to be more focus on race within the boardroom and having those difficult conversations. We've got Dame Fiona Woolf, who's the former Lord Mayor of London, who also said you need different people for new ideas.
But we've been talking about this for a long time, right? Yes. And if you take the 50 points of recommendation, and I think people are reading it and will hopefully change something.
Yes.
But actually, is there any low-hanging fruit that they can do to make a meaningful impact, and then get on with maybe things that they see as more immediate crises?
Yes. The very first thing would be, and we have a lot of male listeners on here, it's that male advocacy. So it's having that male allyship. And there's a big focus on mentorship, but the report also highlights that there's an importance for sponsorship. So having someone within the room, but also coaching. How I got into the corporate boardroom was talking to my male allies who actually put my name in these rooms, and I went for the interview and I got the corporate board role. So I think it's really important to have that. And this is something that everyone can start right now today.
Miranda, thank you so much for joining us.
It's my pleasure.
Miranda Brawn, there from the Brawn Review. Now, it is a big day in terms of news, in terms of markets. Global stocks today, of course, advancing. Look, a strong technology earnings has definitely seemed to be shifting away the focus of investors, away from the lingering threat of U.S.-China trade war, into some of the good news that we've been seeing in technology earnings. We had TSMC today, we had ASML yesterday, and gold. Gold is a huge one because gold's soaring to as high as $4,242 an ounce. Again, taking gains this year to more than 60%. Now, why is gold on a tear? Partly trade frictions, but also expectations for further Federal Reserve interest rate cuts that seem to be luring buyers. The big story, of course, with the Fed is that we also have a government shutdown, and so we just do not have that data. There's a concern that because markets are a little bit dark, that the Fed does something that maybe it'll regret. A reminder, Mark Carney, the Canadian Prime Minister, is the first guest on the Michelle Hussein Show, a new Bloomberg podcast that launches tomorrow. We'll also have Michelle on the show to talk to us about the thought process, and looking forward to some great interviews from her and the team. Up next, Bloomberg Brief, and this is Bloomberg.